Well, according to the bond market, the world has ended. It's not ending, it's actually ended. We're all living in caves and trading wood and silver coins and gold coins. And yes, the world has ended. And oh no, there is Ethereum and Bitcoin. So what is going on? Because we have some conflict of interest going on. Hey guys, this is RC Peck and this is Fearless Wealth. And what you see on the screen is two indexes. On the top, you have the yield of the 30-year U.S. Treasury, right? So that's the yield, or what the U.S. 30-year Treasury bond is yielding. Now, over to the right, you can probably see, it's the lowest it's yielding ever, right? So close of today, and I'm recording this on Thursday, it's yielding below 2%. That's lower than 2016. That's lower than 2015. That's lower than 2012. That's lower than 2011. Oh, hold it. Wait for it. That's lower than when Lehman Brothers went out of business, and apparently the world was ending also. The yield collapse that's happening right now is spectacular. And based on the yield, the aliens have landed on the planet and they are killing us all for their farms in some other universe. But then on the bottom, you have this index called the S&P 500. And both the top and the bottom are just indices, right? There's no dividends reinvested or anything. And I'm going to talk about the 2 red stripes and the 4 yellow stripes. But on the bottom, you have the S&P 500. So there's something really weird going on right now. The bond market is telling you the world has ended and we're going into a deflationary dark age. But the stock market-ish is down about 5 or 6%. Oh, 5 or 6% RC after it's dropped 40%? No. Oh, well, 5 or 6% down after it's been down 30%. No. Oh, well, 5 or 6% down after missiles have been launched across the Pacific between North Korea and the U.S. No. Oh, well, there's that war that we're fighting, that world war that we're fighting. That's why it's dropping, right? No. Well, that doesn't make sense because the market's down 5 or 6%. Again, I'm using the market as the S&P 500 index. And I go, yeah, I agree. That's 5 or 6% off its lifetime high. Lifetime high, guys. Not 52-week high or 52-month high or 52-year high. Lifetime high, right? So the U.S. is about 244 years old, and the S&P is 5 or 6% off its lifetime high. And the yield market in the U.S. is acting like the world has ended. Now, I have this image on because I just want to show you the last time the market fell 50%. So if you put your gaze to the first red vertical stripe, that is from basically September 2000 to May 2003. And on the bottom, though you don't know what the drop is, that's where the stock market fell 50%. Now, there's many ways to measure a stock market. Did you use the NASDAQ, which fell 80%? Did you use small cap, which fell more? Did you use the S&P, which is large cap, which fell 50%? So depending on how you measure the U.S. market, it fell somewhere between 49 to 78%. But if you look at the top screen where the yield is being shown on the 30-year, you see the yield of a 30-year Treasury basically going from 6% to about 4.5%. Okay, kind of makes sense because when the yield goes down, that means more people are going into the bond market. Then if you look at the second and the only other red bar, that's the global financial crisis when the S&P fell 58% over about 18 months. Now, if you look at the top part of the screen, and you're going to have to just stick with me here, and even if you're not watching the screen or you're in a car, it actually doesn't matter because I'm going to describe the horror that is being shown here. So during the global financial crisis, the 30-year yield went from, again, about 4.8%, dropped as low as about 2.6%. But then before the stock market finished its 58% fall, the bond market finally settled at about like a 3.8% yield, right? So started at 4.8, threw up, went down to 2.6, finally resolved at about 3.8. That was a 58% fall, right? And then in 2011, the stock market fell almost 20%, and the bond market really accelerated. The yield market really accelerated to the downside. So it was acting very scared, which makes sense because it was right after the global financial crisis. Okay, and then we have, I'm going to the second yellow bar. This is late 2015, early 2016, where the US stock market had two 14% corrections. And during that time period, the bond market, the yield, I keep saying bond, the yield market of the 30-year went from about 3% to 2.75%. Okay, stick with me here, guys, because there's some really clear points that are coming out, if not already. Then we go to the stock market correction last year, which was less than 20%, and the bond market, the yield market, didn't really do anything. Now, I wanted to go through 1, 2, 3, 4, 5 the 5 last corrections of the stock market to point out that what is going on today in the yield market is confounding. I believe what's actually happening is people are tuning in more and more to the noise machines, right? And they're hearing trade war, and they're hearing that the Thai central bank, like people don't even know where their own country is on the world map, let alone where Thailand is. And I don't even know what the GDP of Thailand is. I think it's probably, 1/10 of Silicon Valley, if that. But people are freaking out. And that's why you see the yield on the 30-year absolutely collapsing. I think we can call that a collapse. Okay, now some people say, yes, but RC, it's collapsing because the market's going to collapse. But that's actually not how it looks. If you just looked at the last 20 years, and we did just look at it together, I'm doing air quotes now, the only other time the yields collapsed was when we were already in a recession, when the market had already peaked 12 months before that, 9 months before that. Guys, we're like 2 weeks away from its old lifetime high. So there's such trauma and drama going on. And I'm not diminishing them, but it's amazing how as people get more disconnected from what's actually happening and more connected to noise machines and sound machines and cortisol drip machines, the more scary things I'm seeing with money. Now look, if the stock market starts falling, we'll step aside, guys. We'll step aside, we'll step out, no problem. But one of them is wrong, right? Either the yield market is wrong or the stock market is wrong. Right now, until further notice, I'm going to say the yield market is wrong. The yield market usually has people in their 50s and 60s and 70s. They're super scared of losing more. They're reading very scary headlines. So even though the stock market's only down 5 or 6%, they're absolutely scared. I'm not saying they should be or they shouldn't be, but they haven't been trained to look at the markets, right? They've actually been taught to listen to people's commentary. And those things they've been taught to listen to really scare their brain. And that's what you're seeing here is a very, very, very scared market right now. And again, if the stock market actually starts falling, we'll do something about it. Okay, so what are the steps here? The first is, look, you got to get trained to know how to ask the right questions. So you can literally say, okay, well, if the yield market falls, right, if the 30-year U.S. Treasury bonds yield goes from 2.6% to 1.98%, but nothing else collapses or reacts, is it important? Or has something changed? Or is the world leading into a deflationary period? And what we're seeing is how deflation is accelerating, right? So it's about getting the better questions. It's about getting your conversation out of your brain and into a dialogue with other people who may have different opinions. But of all the things I could show you this week, it's really 2 price charts in one, Again, comparing at the same time, same president, the top and the bottom, watching the 30-year yield change as the stock market went through two 50% corrections, and where we are right now. And again, I think there's a big disconnect going on. And to keep your heads level and to really get trained to think in a way where you can say, okay, well, if it starts to get bad, meaning in the stock market, I will do something. But right now, there's a huge discrepancy between the two. Hey guys, I hope this helps you, and this is just another step in helping you protect and grow your money. Until next time, this is RC Peck.